Namaste friends, मैं प्रकाश शर्मा. I am happy to share with you another episode of Pahal. Today we will understand about a topic with which many small businesses are concerned, that is the filing of income tax returns under the Presumptive Taxation scheme. Once the financial year is over, many of us are under pressure to file the annual income tax return ITR. There is no need to take any tension. Today we will learn about the basics of income tax and how easily you can file the ITR on your own with minimum hassle. We will talk in detail about the sections related to maintenance of accounts, audit of accounts, and filing of ITR 3 and ITR 4 under the Presumptive Taxation scheme. If you want to get more knowledge about the basic concepts related to income tax and ITR filing, please watch my video on ITR 1, the link for which is shared here. What is Presumptive Taxation scheme? Normally, books of accounts must be maintained and a profit and loss account and balance sheet must be prepared to know the income and financial status of a business or profession. However, under the Income Tax Act 1961, a simple method has been provided for small businesses to work out the income for tax return purpose. A person adopting the presumptive taxation scheme can declare income at the prescribed rates. The different sections prescribed in the scheme of presumptive taxation are explained as we will begin with section 44A, which relates to maintenance of accounts by certain persons carrying on profession or business. What is books or books of account? That includes ledgers, day books, cash books, account books, and other books, whether kept in the written form or in electronic form or in digital form, or as printouts of data stored in such electronic form. Every person carrying on business or profession, not being a profession referred to in subsection 1, shall, if his income from business exceeds 1,20,000 rupees or his total sales, turnover or gross receipts as the case may be, in business exceeds 10 lakh rupees in any of the 3 years immediately preceding the previous year, or where the business is newly set up in any previous year, if his income from a business is likely to exceed 1,20,000 rupees or his total sales, turnover or gross receipts as the case may be in business are likely to exceed 10 lakh rupees during the year. So if either income or sales or receipts are more than the given limits, books of accounts must be maintained. However, in the case of a person being an individual or a Hindu undivided family HUF, the provisions of clause 1 and clause 2 shall have effect as if for the words 1,20,000 rupees, the word 2,50,000 rupees had been substituted. And in the case of a person being an individual or a Hindu undivided family, the provisions of clause 1 and 2 shall have effect as if for the words 10 lakh rupees, the words 25 lakh rupees had been substituted. So we can see in case of an individual or HUF, the prescribed limits for maintaining books of accounts is higher as compared to other assessees. Now coming to section 44AB, which relates to audit of accounts of certain persons carrying on business or profession. Every person A carrying on business shall, if his total sales, turnover or gross receipts as the case may be, in business exceed or exceeds 1 crore rupees in any year,
get his accounts of such previous year audited by an accountant before the specified date and furnish by that date the report of such audit in the prescribed form, duly signed and verified by such accountant, and setting forth such particulars as may be prescribed.
However, in case of a person whose aggregate of all amounts received, including amount received for sales, turnover or gross receipts during the year, in cash does not exceed 5% of the said amount, and aggregate of all payments made including amount incurred for expenditure in cash during the year does not exceed 5% of the said payment, this clause shall have effect as if for the words 1 crore rupees, the words 10 crore rupees had been substituted. In short, if the business transactions of receipts and payments are done through online or digital channels and where the identity of paying and receiving parties can be easily established, it benefits the business by reducing the compliance burden. Again, to relieve some small taxpayers from such compliance burden, the Income Tax Act has framed presumptive taxation scheme under sections 44AD, 44ADA and 44EA. A person adopting the presumptive taxation scheme can declare income at the prescribed rate without providing detailed profit and loss account and balance sheet in the ITR. The Act has provided the scheme as given. Section 44AD, special provision for computing profits and gains of business on presumptive basis. There is a threshold limit to opt the presumptive taxation scheme. The threshold limit of turnover is rupees 3 crore if the aggregate of business receipts in cash or similar mode does not exceed 5% of the gross receipts in the year. Otherwise, the limit is capped at rupees 2 crores. Subsection 1. Notwithstanding anything to the contrary contained in sections 28 to 43C, in the case of an eligible assessee engaged in an eligible business, a sum equal to 8% of the total turnover or gross receipts of the assessee in the year on account of such business, or as the case may be, a sum higher than the aforesaid sum claimed to have been earned by the eligible assessee, shall be deemed to be the profits and gains of such business chargeable to tax under the head profits and gains of business or profession. Further, this subsection shall have effect as if for the words 8% the words 6% had been substituted in respect of the amount of total turnover or gross receipts which is received by an account payee check or an account payee bank draft or use of electronic clearing system through a bank account or through such other electronic mode as may be prescribed. The provisions of this section, notwithstanding anything contained in the foregoing provision, shall not apply to number 1. A person carrying on profession as referred to in subsection 1 of section 44AA. 2. A person earning income in the nature of commission or brokerage. Or 3. A person carrying on any agency business. For the purposes of this section, eligible assessee means an individual, Hindu undivided family or a partnership firm who is a resident but not a limited liability partnership firm. Eligible business means any business except the business of plying, hiring or leasing goods carriage referred to in section 44AE and whose total turnover or gross receipts in the previous year does not exceed an amount of 2 crore rupees. However, where the amount or aggregate of the amounts received during the year in cash does not exceed 5% of the total turnover or gross receipts of the year, this subclause shall have effect as if for the words 2 crore rupees, the words 3 crore rupees had been substituted. However, the receipt of amount or aggregate of amounts by a check drawn on a bank or by a bank draft which is not an account payee shall be deemed to be the receipt in cash. Now let us understand about the ITR forms. There are two ITR forms for this category for assessees. ITR 3 for individual and HUF engaged in business or profession where both tax audit and non-tax audit cases under the presumptive taxation scheme is not opted and they are not eligible to file ITR 1, ITR 2 or ITR 4. Then there is ITR 4 which is for resident individuals, HUF firm other than LLP having income under business or profession under section 44AD, 44ADA or 44AE computed on a presumptive basis. In India, there are nearly 2.5 crore taxpayers who file ITR 4. Only taxpayers having income from the given sources not exceeding rupees 50 lakhs is eligible to file ITR 4. Number 1, the sources, salary and pension. Number 2, one house property. 3, one's other sources, interest, family pension, dividend, etc. And excluding winning from lottery and income from race horses. Number 4, agriculture income up to rupees 5,000. Number 5, long-term capital gains under section 112A up to rupees 1,25,000. ITR 4 form cannot be used by a person who, number 1, is a director in a company. Number 2, has held any unlisted equity shares at any time during the previous year. Number 3, has any asset including financial interest in any entity located outside India. Number 4, has signing authority in any account located outside India. Number 5, has income from any sources outside India. Number 6, is a person in whose case payment or deduction of tax has been deferred on ESOP. 7, has any brought forward loss or loss to be carried forward under any head of income. Number 8, has total income exceeding rupees 50 lakhs. Number 9, has income from short-term capital gains. And number 10, has income from long-term capital gains other than under section 112 up to rupees 1.25 lakhs. Please note that ITR 4 is optional and not mandatory. It is a simple form compared to ITR 3, however one must be eligible to file ITR 4. Category of assessees and their due dates for filing of return. For individual and HUF, it is 31st July of the assessment year. For financial year 24-25, it has been extended to 15 September for the non-audit cases. And the tax slab for individuals less than 60 years applicable for financial year 24-25 under section 115 BAC, which is new regime for the financial year 24-25. If the income is up to rupees 3 lakhs, the tax rate is nil. From rupees 3 lakh 1 to rupees 7 lakhs, it is 5%. From rupees 10 lakh 1 to rupees 12 lakh, it is 15%. From rupees 15 lakh 1 to rupees 50 lakhs, it is 30%. And from rupees 50 lakh to rupees 1 crore, 30% tax plus surcharge of 10%. And the last slab is for income above rupees 2 crore on which tax is 30% and surcharge is 25%. Let us understand about the selection of the tax regime. After the amendment by Finance Act 2024, the new tax regime is the default tax regime for an individual HUF However, the assessee has the option to opt out and choose old tax regime. The option to switch to old tax regime and withdraw from it in any subsequent year can be exercised only once in lifetime of a taxpayer having income from business and profession. For this purpose, Form 10 IEA has to be submitted before the due date of filing ITR 1. Rebates under Section 87A. Under the old regime, an assessee being an individual resident in India whose total income does not exceed 500,000 rupees shall be entitled to a deduction from the amount of income tax as computed before allowing the deduction under this chapter on his total income with which he is chargeable for any assessment year of an amount equal to 100% of such income tax or an amount of 12,500 rupees, whichever is less. So the rebate amount is rupees 12,500. And under the new regime, section 115 BAC for the financial year 24-25, where total income does not exceed 700,000 rupees, the assessee shall be entitled to a deduction from the amount of income tax as computed before allowing for the deductions under this chapter on his total income with which is chargeable for any assessment year of an amount equal to 100% of such income tax or an amount of 25,000 rupees, whichever is less. So under the new regime, it is 25,000 rupees. Now some of the applicable forms for ITRs are Form 16, Certificate of Tax deducted at source on salary under Section 203. This is provided by the employer to employee. It provides the salary, income and the TDS details. Form 16A, Certificate of Tax deducted at source on professional income. This is provided by the director to deductee. It provides the nature of payments, income credited or paid and TDS details. Form 26AS, that is AIS, Annual Information Statement. This is provided by the Income Tax Department. It gives the income and TDS details. You can note down the income tax website. It is eportal.incometax.gov.in. You can log in on the home page on the login tab, which is provided in the upper right hand corner of the home page. Use your PAN number for login, and if you are not yet registered, use your PAN number to create your login ID. Once you have the necessary data available with you, log into the income tax return filing portal and follow the given steps. Normally, you will require the following: Number 1, bank statement. Number 2, housing loan interest certificate. Number 3, interest earned certificate, insurance receipts, rent receipts. The site is user friendly. Please link Aadhaar and PAN if not yet done. First, familiarize yourself with all the sections which you need to fill up. After filling up the data, there is a process of validation which ensures there are no logical errors. You can download the filled form for review. If there are no discrepancies, you can do online verification. Please share this video with as many persons as possible so that they can also benefit. You can write in the comment section for further clarification, feedback or for a free consultation. I hope to get your encouragement to produce more such videos on matters of interest to the common man. Kindly like and share the video and subscribe to my channel. Thank you for watching. Have a good day.